But my next guest is warning there are some headwinds looming. Joining me is Liz Suzuki, research analyst at Bank of America Securities. Liz, it's great to have you because this was a surprise to me. We've all been talking about this huge demand for auto parts, and why do you think that it may start to slow a little?
Yeah, so I think, the auto parts retail industry is actually really interesting because it gets overlooked relative to the rest of the retail industry. It's not as trend driven, and it's also overlooked relative to the rest of autos. It's not as high profile as the manufacturers like GM and Ford, but it does have attractive long-term fundamentals that we think still hold up over the long term. So thinking about the profitability, which is higher than that of the average retailer in terms of operating margins, and relative to the rest of autos as well, and the consistent long-term growth in the industry. Now, that consistency has kind of been rocked by COVID-19. So, when we look at what has happened so far this year, as soon as the virus hit, lockdown became the big trend, and then that was a big issue for driving activity. No one was on the road, no one was going to their workplaces, and so miles driven came down significantly. And then, and so did auto parts sales. And then we got into mid-April when stimulus hit, and all of a sudden we had this massive inflection point higher from sales being down double digits to being up double digits. And that strength has actually persisted throughout the spring and summer. But we think that, as stimulus fades and as we get past that strength and the pent-up demand in auto parts starts to taper out a bit, we think that DIY auto industry in particular is likely to see a correction more towards the normal growth rate of that sector, which is more low double digits or low single digits rather.
Yeah.
Shepard Smith here. Thanks for watching CNBC on YouTube.